All right, let's talk about Chewy. Their latest earnings report just dropped, and honestly, it's a complete head scratcher. The company absolutely crushed it. They beat estimates, they raised their forecast for the year, and then the stock just nosedived. So, what in the world is going on? Let's figure out what Wall Street is seeing that the rest of us might be missing.
And this is the paradox right here. I mean, look at this. On the left, you've got everything an investor wants to see: a beat on revenue, a raise in guidance, thumbs up all around. But then you look at the right side: a brutal, nearly 17% drop in a single day. It just doesn't add up. So, what did the market see that triggered such a massive sell off?
Okay, so to get to the bottom of this, we've got to start with the basics. Let's quickly run through the headline numbers, what Chewy actually reported, because on the surface, things looked really, really good. First up, the top line, revenue. They brought in over $3.1 billion. That's up a solid 8.6% from last year. And what's really important here is that number was better than what all the analysts on Wall Street were expecting. So check mark number one, right? Strong demand, looks great. But it wasn't just, empty calorie growth. The company actually got more profitable, which is huge. Their adjusted profit margin grew by 80 basis points. Now, basis points is just Wall Street jargon for 1/100%. So an 80-point jump is a big deal. It tells you they're running the business efficiently, and that is exactly the kind of thing you want to see. And this right here is the engine room of their entire business. Autoship, their subscription program, is a monster. It now accounts for 83% of their sales, and it grew 15% year over year. For anyone investing, this is the holy grail. It's predictable, it's reliable, it's recurring revenue you can pretty much count on. Which, of course, brings us right back to our big mystery. They beat on sales, they're making more money, and their core subscription business is absolutely on fire. So I have to ask again, what on earth is the problem here? Well, to understand the disconnect, you have to get inside management's head. See, they're playing chess, not checkers. It's not just about getting more and more customers in the door. It's about getting each of those customers to spend more money with them over time. And you can hear it straight from the CEO, Simit Singh. On the earnings call, he kept pointing to the strength of Autoship and how they're growing in other areas, like hard goods. He's basically telling investors, hey, our existing customers are incredibly loyal, and we're successfully selling them even more stuff. It's all about deepening that relationship. And this is their playbook for doing it. They're pouring their profits into these big initiatives. You've got the new Chewy Plus membership, a huge push into pet pharmacy and health, which has great margins, by the way, and they're even launching their own private brands. The goal here is to build a sticky ecosystem. They want to be the one-stop shop for your pet, so you never even think about going anywhere else. Okay, so that's management's strategy. It's a long-term plan. But the market wasn't looking at the long term. It zoomed in on one single metric that just overshadowed everything else. I'm not kidding. Despite all that good news we just went through, for a ton of investors, the entire quarter, the whole story, it all boiled down to just one number. And here it is. This is the culprit. Active customers grew by 4.5%. Now you're probably thinking, wait, growth is growth, right? 4.5% is still positive. And you're not wrong, but context is everything in investing. The stock had already run up almost 26% this year before this report, so expectations were sky high. And for a hot stock like Chewy, 4.5% just felt slow. It wasn't enough. And this gets to the heart of how these high-growth stocks work. Think of it like this. You don't buy a racehorse because of how fast it ran yesterday. You buy it for how fast you think it's going to run tomorrow. Investors pay a premium for stocks like Chewy based on the promise of explosive future growth. The very second it looks like that growth might be slowing down, even a little bit, people panic. They redo all their math on what the company's worth, and that's what triggers a sell-off like this. So this really lays out the two completely different conversations that were happening. On one side, you have management talking about the long game, growing the value of each customer and building this unbeatable ecosystem. But on the other side, you have the market, with its headphones on, laser focused on one question: how many new people signed up right now? Two totally different perspectives. So that's the story of what just happened. The real question is, what happens next? Let's get into our take, what we're calling the next call. All right, here's our cheat sheet for Q3. We're assigning Chewy a market perform rating, and here's why. We think that customer growth number is probably going to stay in this same slow and steady range, somewhere around 4 to 4.5%. The real game changer, the catalyst we're all watching for, is proof that their new Chewy Plus program can actually kickstart that user growth again. Until then, even with strong profits and sales, we think the stock is probably going to just tread water for a bit. Okay, now for a potential trade idea. And just so we're clear, this is not financial advice. The whole premise here is that the 17% drop was a massive overreaction. So the idea is something called a paired trade. It's like betting on a big game. You pick one team to win and another to lose. Here, you'd go long Chewy, betting on its success, while at the same time you'd short a basket of weaker, more generic retail stocks. The rationale is that Chewy's subscription model is its superpower, making it way more resilient than its competitors, especially if the economy gets a little rocky.
So really, it all boils down to this one question. Is the market seeing a real crack in Chewy's armor? Or is this just a classic case of Wall Street short-term obsession, creating a massive long-term opportunity for everyone else who's willing to look at the bigger picture?
And as always, remember, this is not financial advice.